Factor investing is a well-documented way of beating markets over the long term. And in this video, we'll look at a practical way in which you can do this yourself using single stocks. We'll also look at the evidence that this strategy is outperformed in the UK, but also in international markets historically. I'll also update you on the performance of my own UK portfolio built along these lines. This video is sponsored by Stockopedia, which provides easy-to-use research tools that save you time, help you act more decisively, but also improves your success rate. So let's look at a strategy for beating the market long-term in a bit more detail. So what do we mean by beating the market? Now, there's been a huge amount of research looking at the types of stocks which do outperform the broad market. So let's say you're buying US stocks, you're trying to pick the stocks which will beat, say, the S&P 500. In the UK, you might be looking at beating the UK All-Share Index. But the way in which you do that is to systematically tilt your portfolio to a particular style of stock. And we'll discuss these styles in a moment. But by producing these tilts in your portfolio, then you can outperform the market, but it can take a long period of time for this to happen. Now, a key point here is that it's all about the execution. If you're not willing to stick with a strategy over the long term, whether it seems to be working or not, then you will not outperform the market. Some of these strategies, some of these factors underperform for long periods of time. And you've just got to go through those fallow periods and hope that you come out the other side. And another key point is that while these factor approaches have worked in the past, it doesn't necessarily mean that they're going to work in the future. Now, as many of you know, I separate my portfolio into two chunks. The core part, which is about 90% of my investments, is invested in just a single global equity fund. 10% of my investments are in a fund portfolio. So when I try to beat the market, it would definitely go into the fun part. The reason why that's so small is that I don't hold out much hope that I can beat the market. But that doesn't stop me trying. And I have a great time learning about stuff while I'm trying to beat the market. So now we've got the caveats out of the way, let's look at some of those factors. Now, MSCI does a great job of categorizing these factor approaches to investing and producing actual indices which asset managers can then track with funds. So in many markets, you can buy factor funds that provide you with an off-the-shelf portfolio which has these factor approaches. So MSCI characterizes this factor approach to investing as being somewhere between two extremes. On the one hand, we've got passive funds which just track an index. That's called beta, and usually you can do that very cheaply. And then at the other extreme, you pay a fund manager to outperform an index. And often that's quite expensive to do. So factor investing sits in the middle between those two extremes, and you can almost think of it as an automated version of an active fund. It tilts the portfolio away from a market cap benchmark towards something which historically has outperformed. So what are these factors? Well, they'd be things like value. Warren Buffett is a very well-known value investor where he buys cheap stocks and hopefully those stocks outperform over the long term. Another approach might be to buy small caps. Again, historically, small caps have outperformed large caps. Another approach might be to have momentum stocks. These are stocks which have a rising price rather than a falling price. Or perhaps you'd go for quality. These are stocks of companies which have very strong balance sheets, combined with good earnings growth, not too much leverage. So while research has identified the types of stocks which have outperformed historically, the job of an index company is to create indices which can then be tracked by an asset management company. However, these aren't available for all markets or for all combinations of different factors, because it is possible to combine more than one factor. For example, you could go for small cap value. These are small companies which are also cheap. That's a factor which has done very well historically. So in the United States, the Bogleheads group, which are fans of Jack Bogle, as I am, they've produced this Simba spreadsheet which has total return data going back to 1927. And what you can see here are the returns of various combinations of different factors. And this is on two dimensions, small caps, large caps, and at the same time, the continuum goes from value to growth, which is seen as opposite factors. Now, compared to the US total market, the return of small cap value has been significantly higher. Small cap values generated 8.7% returns on average since 1927, whereas the total US market has only returned 6.5%, which is a huge difference if you compound it for that period of time. However, that outperformance has not happened in a straight line. There have been long periods when small cap value has underperformed. In fact, the latest decade has been just one of those periods. Remember, what's been doing really well over the last 10, 12 years is large cap growth companies, companies like Apple, Google, Microsoft. So since 2010, the total real return of small cap value has been just 6.9% per year, whereas large cap growth has generated 9.3%, and the total US market has generated 8.6%. So small cap value has underperformed for some time. Does that mean that this combination of factors has stopped working? Well, it's unlikely, but it would be very difficult to stick with this approach to investing after it's underperformed for over a decade. So this approach that we'll be discussing today is not for the faint-hearted. You've got to believe in it and you've got to stick with it. Another key part of the approach that we'll be discussing is sector diversification. Now, sectors are just industries, and you can classify industries in multiple ways. This is a classification created by Stockopedia, who's sponsoring the video today, and whose system of outperformance we'll be studying. Now, you can see that there are 10 sectors in total here, and they're broken into 3 groups. Defensives provide protection when there's a downturn in the economy. So that would be sectors like healthcare, consumer staples, these are the things you have to buy, and of course utilities, which we all need even if there's a recession. Cyclicals are the other extreme, which perform well during an upturn in the economy, so that would include things like banks, but also basic materials, and then sensitives lie somewhere between those two extremes. Now, the key point is that within an industry, within a sector, stocks tend to be highly correlated with one another. Their prices tend to move up and down in sync. So if you want a diversified portfolio, you'd ideally hold stocks across as many sectors as possible. For example, if we look at 2 years of price data for 4 stocks, now 2 of these stocks are energy companies. This is Shell and BP in the UK. And 2 of the companies are financials. This is Lloyds and Barclays. Now, although they don't lie exactly on top of one another, you can see that the energy companies tend to move up and down in sync. Both are sensitive to the oil price, for example, and that'll push the price of those companies up and down. Whereas if we look at banks, they're more likely to be sensitive to something like interest rates. So if we want diversification, we'd hold one of the banks and we'd hold one of the energy companies. We wouldn't hold 2 energy companies or 2 banks. That would reduce our diversification benefit. Now, to familiarize yourself with Stockopedia, because we'll be using some of its data in a moment, this is what the screen looks like. Now, I'll start off talking about the UK and the FTSE All-Share Index, so I'm focusing on the UK here. But there are multiple regions of data that you can buy in your subscription with Stockopedia, and the principles we'll be discussing apply to any region. But what you can see here is called a screen. This takes all of the stocks listed in the UK and it ranks them according to certain criteria, and it filters based on certain criteria. So this is a portfolio which I built previously to create a small cap value momentum quality portfolio. You can see the criteria I applied here at the top of the screen, and you can see that these are sorted by something called a stock rank, and that combines 3 different criteria. So if we drill into Smith's News, you can see that it has these scores in the top right of the screen, as well as lots of fundamental data about the price and the balance sheet and the earnings of this company. These green circles tell me the quality, value, and momentum ranking of this stock. So 100 is a high ranking, and that's good. If we combine these 3 different rankings, we get the stock rank of the stock. So these are percentiles, so 100 is good and 0 is bad. Now, you don't have to use these rankings in the top right, but I just find it very handy to summarize the data about each stock using the ranking system. For example, if you wanted to, you could drill into the fundamental data for each stock and come up with your own ranking system. Now, if you want to try out Stockopedia for yourself, you get a 25% discount as a viewer of PensionCraft. And this comes with a 14-day free trial and a 30-day money-back guarantee. You can also use the discount code, which is PC25. And you'll also find a link to this offer in the description of this video. So how can we use this stock rank system to try and beat the market? The intuition here is that if you combine those three factors, quality, in other words, good companies with strong earnings growth and strong balance sheets, we'd combine that with value, so we wouldn't overpay for those high quality stocks, and we'd combine it with momentum. We don't want stocks that are deteriorating even though their fundamentals currently look good. And we also don't want stocks whose price is falling, perhaps because the market senses some kind of weakness. So we're looking for stocks which have high quality, which are cheap, and which are the leaders. So if we apply that screen, which is to look at the stock ranks of certain stocks, and we go from the 0th percentile, these are the worst stocks based on that ranking system, up to the best, which would have a stock rank of 100, and we break it up into deciles. So the best decile would be between 90 and 100. Now, if the system works, you'd expect those high-ranking stocks to outperform after they've ranked highly. And this backtest applies to UK stocks with a market cap of greater than £10 million, and these portfolios have been rebalanced every quarter. And what we see is that indeed, stocks with a high stock rank have performed very well. They've performed best. They've also outperformed the UK All-Share Index. So at least we know that this looks promising. However, this approach may not work in practice if you're building your own portfolio, because that top decile is still 10% of a huge number of stocks. You don't want a portfolio which has hundreds of stocks to manage. So what Stockopedia has come up with is something that they call the No Admin Portfolio System, or NAPS. So the first step is to look at the stock rank of all of the stocks in a market, in this case the UK, based on their stock rank, which is a combination of quality, value, and momentum. Now, you probably want to avoid stocks which are absolutely tiny and which are very difficult and expensive to trade. So it's usually sensible to set some lower market capitalization for stocks. Then in order to get sector diversification, we then go down our list of stock ranked stocks and choose the 2 best from each sector. So in total, if we have 10 sectors, we end up with 20 stocks, with 2 from each sector. We then buy that portfolio and repeat the whole process every year. So really the only administration involved in this process is every year you look at the latest stock rank stocks, you sell the previous batch of stocks, and you buy the new ones. So it's not no admin, it's some admin but very little. Now Stockopedia has tracked how well this portfolio has performed going back about 9 years. And you can see that it's outperformed the FTSE All-Share significantly. There are some caveats, so this doesn't include dividends, and the strategy which has been employed has varied slightly over time. What you can also see is that there have been periods of underperformance. It's not a straight line outperformance. So out of the gate, between 2015 and 2018, the performance of this strategy was very good. Then there was a 1.5-year period of underperformance. That's the red arrow, which you can see here. Then after the big pandemic sell-off in stocks, we had this huge rally in this strategy. However, for the last 2 years, the strategy's underperformed. So as I said at the beginning, you've really got to be able to stick with these strategies if you believe they'll outperform. You can't just mix and match and change strategies halfway through. So you're probably thinking, how well does this compare with active management? It's interesting that over this 9-year period, the strategy's beaten every single active fund in the category defined as the Investment Association UK All Companies Funds. Now that includes 187 UK actively managed funds. It doesn't always outperform active managers, so for example over the last 5 years it comes in 15th place. But still, this shows that it is a strategy that's worth consideration. And as we saw in 2023, these strategies underperformed. So for example, the FTSE All-Share is up by around 4% over that period, whereas the NAPS portfolio is only up by just under 2%. Now I said I'd mention my strategy and bring you up to date with how well that's doing. That's also based on a Stockopedia screen. In this case, it's a tilt towards small caps, but also stocks which have a high stock rank. Now I started that in October of 2023, and in January of 2024, it's only up by around 3%. So fairly underwhelming performance, but like I say, I'm willing to stick with it for a long period of time. Now, one of my regrets when I built the portfolio is that I didn't have good sector diversification. I just loosened the filters until I had a reasonable number of sectors in my portfolio. However, if we use one of the Stockopedia features, which is that you can upload your own portfolios, you can track its performance as you can see here, but if you click on the allocation tab, it actually breaks down the sector composition of your stocks. And you can see that mine is very concentrated in industrials. That makes up about half of my portfolio. So perhaps my strategy should have been to have a wider range of stocks and take 2 from each sector. Maybe I will improve my strategy next time I rebalance. But what I am pleased with is that my style composition by using stock rank is almost all super stocks. Now you may be wondering how well the strategy would perform in other markets. And Stockopedia has done these back tests. So these are all stocks with a stock rank of greater than 75. They have a market capitalization of at least £20 million, and a maximum of 2 stocks is selected from each of those 10 sectors. And these are equally weighted portfolios which are annually rebalanced. So it is the NAPS strategy. And for countries where we have data going back to 2013, of which there are 5 based in Europe and Scandinavia, you can see that the strategy's outperformed to different degrees. For the US, we've got data going back to 2014, and here what's interesting is that it's underperformed for the Nasdaq. Remember, what's done well over the last decade is large cap growth, and remember we have a tilt to value. But for the US market overall, the strategy has outperformed. And for Australia and New Zealand, India and Japan, it's only one of those markets, Japan, in which the strategy's underperformed. Now, the examples we've seen so far were annual rebalancing, but there are other ways to do it. For example, if you're holding your investments outside a tax-sheltered account, which in the UK would be an ISA or a SIPP, then you might have to worry about things like capital gains tax if you sell for a profit. Or it might be income tax if you're generating income with some of your stocks. So that might be a consideration when you're building your portfolio. Maybe you want a tax loss harvest, for example. Another consideration is trading cost. On some platforms, there's a fixed fee to trade. For example, it might be £6. And if you're just trading a £100 stock at a time, then that would be 6% of your investment, a huge fee effectively. And that would really push you towards rebalancing very infrequently. If you're on a commission-free platform, on the other hand, then you'd be less worried about trading costs, although they'd still be there because of the bid-offer spread. Market makers ensure that you have to buy high and sell low if you trade a lot. Another approach might be to say, well, I'll monitor my portfolio every day, and if my stock rank falls below my threshold, then I'll sell the stock. That would apply if you don't have high trading costs or any tax implications of selling, because that strategy would tend to churn quite a bit. Or another approach would be based on the size of your allocation. Initially, you'd start off with equal weighting, but then as some of the stock prices increase, others fall, you'll end up with more or less of the stocks. So if you cross some kind of threshold, say 10% gain, 10% loss, you could rebalance. So I don't think this approach is for everyone. I think you've really got to be disciplined when it comes to allocation. And you've just got to stick with this approach, even if it's going to underperform for fairly long periods of time. Now, it has underperformed for 2 years, for example, in the UK. That was the longest period, I think, but you should be prepared for that. But like I say, I have built a strategy like NAPS in my own fund portfolio. But again, that's only a small proportion of my total investments. My core is still very much based on buying a global market index. That makes up 90% of my investments. Now, don't forget our offer from Stockopedia if you want to try it for yourself. If you use our discount code PC25 or use the link in the description, you'll get a 25% discount. And it comes with a 30-day money-back guarantee. And as always, thank you for listening.